What's up, everybody? Welcome to Heresy Financial. My name is Joe Brown, and on Wednesday, April 14th, 2021, Bernie Madoff died in prison at the age of 82 with about 140 years or so left on his prison sentence. Now, just in case you're not familiar, Bernie Madoff was the one who led the largest private Ponzi scheme in history. And yes, I say private on purpose because, let's be honest, we're not talking about Social Security here. We're not talking about the big Ponzi schemes. And so today we are going to look at what we can actually learn from this story because, yes, it is a story marred by tragedy and malevolence, but there are some things that we can learn, some things that we can take away from this, especially as individual investors, so that we don't wind up as a turkey. Ready? Let's dive in. Bernie Madoff led the largest Ponzi scheme, largest private Ponzi scheme in history, defrauding somewhere around 37,000 investors from countries all around the world. But at the start of his career, he didn't set off and intentionally decide that he was going to do this. He started off as, running a legitimate hedge fund where investors gave him money and he invested it for them. According to Bernie Madoff, the fraud started in 1990 when the markets went down and he didn't have the guts to tell his investors, hey, your money's worth less now than it was before. And so he just said, no, I made better investments and you made more money instead of losing money. And he said his initial intention was that at some point he would make up the difference and get the accounts back to where he said they actually were and then stop the lying. But obviously once you start something like this, it's pretty much impossible to stop it from getting worse and worse as time goes on. And that's exactly what happened. But the problem is when you are fraudulently making up numbers, number one, it's very difficult to do it in a way mathematically that looks like reality. And number two, especially when you are trying to convince investors that you're making money for them, you're not going to do it in a way that reality would correspond with, because then you open yourself up to risk of failure. And here's what I mean by that. The returns that Bernie Madoff's fund started posting were consistently high, around the realm of 12% or so per year, with almost no volatility, no drawdowns, no large spikes, just consistent high returns year after year, month after month. Now, the thing is, this isn't actually possible in the real world. And there were people who realized this, dug into it to figure out, hey, how are you posting these returns? Because this isn't possible. So they'd call up and they'd ask him or ask somebody on the trading desk. They'd be like, hey, look, we noticed, that you were invested in this. That went down. How'd you still post returns? And the answer would come back something like that he had protected it with a put option. He had bought a put option on it. So they got the details of the trade and then they went and looked and realized he said he bought this put option on this stock, let's say, and then they went and looked and there were no transactions, there were no trades of that specific contract traded within the time frame that he said. And so obviously these were reported, these were filed, these went to the SEC, but either the SEC just didn't have the manpower to enforce all the regulations, or when they did the investigations, they just didn't understand his responses and his defenses, and so it never got caught from up above. And ironically, without the great financial crisis happening, this would have potentially been able to go on indefinitely, because when you post returns like this, investors, especially who don't understand, hey, this really isn't possible, you'll start to look at that and say, hey, I want to put my money in that. They never lose money. They consistently make a lot more money than anybody else is making. Why not? It's virtually guaranteed. It's free money. Let's do it. And so you start to attract more and more money. And for a Ponzi scheme, this is exactly what you need. Because the definition of a Ponzi scheme, I know the word gets thrown around a lot, but the definition of a Ponzi scheme is where you are generating returns solely through new investor contributions. And so for a long time, Bernie Madoff's hedge fund, they never invested a single dime. They put all of their money into a checking account with Chase, literally. And anytime an investor came and said, hey, I want to withdraw my money, you said my money's been growing this much every year, I know I have this much, I want to take some out, he just sent him a check from the checking account. And it was all right because the fund was doing so well, fraudulently, but it looked like it was doing so well that they were attracting so much new money that they had enough new money coming in from new investors to pay out any investors that were taking their money out. Quite honestly, nobody really wanted to take money out because it was doing so well. But the financial crisis, when it started to happen, when a crisis happens, people don't sell what they want, they sell what they can. And so obviously when you have everything in the world crashing, maybe you lose your job, maybe you lose your net worth or half your net worth from your stocks going down, or you were in real estate or whatever, you're going to go to this hedge fund that, has been still performing well and hasn't lost any money. You're going to say, hey, I need some money. And so people started to withdraw their money. Words started to get out. People started to get suspicious, especially when they continued to post high returns when it looked like everybody else was losing money. Kind of like a run on the bank happened, and then the tide flipped and it switched over. More people started withdrawing money and requesting money to be withdrawn than there were investors plowing money back in. And that's the peak. That's when a Ponzi scheme collapses, when more money starts getting withdrawn than is coming in, because you don't have any products being sold. You don't have any investments in any real companies with any real returns. You're just generating returns from new investor contributions. And just in case that structure sounds familiar, yes, that is 100% exactly the way that Social Security works. Well, once he realized he couldn't keep up the act any longer, he told his two sons, who immediately turned him in. The FBI raided the building the next day. He pled guilty in court and got sentenced to 150 years in prison. Now, like I said, tragedy for almost everybody involved. In fact, his two sons aren't even alive any longer. One of them committed suicide. One of them died of lymphoma. And obviously, everybody who invested in the fund lost a ton of money. But some things on the bright side. Number one, we can learn some things. And number two, investors have recovered 80% of their funds that they invested into this, which for a Ponzi scheme, that's unheard of. So absolutely fantastic work done by everybody who is seeking restitution and trying to resolve this for all the investors who were defrauded. Unheard of in history, and they've done a fantastic job at getting people back the funds that they lost. So then, what can we learn from this? Well, don't be a turkey. And here's what I mean by that. Nassim Taleb popularized this in his books, Black Swan, Anti-Fragile, Skin in the Game. And basically the turkey is, the character. It's a turkey who says, every day, my master feeds me. My master keeps me, gives me water. My master gives me a place to sleep. And so he believes every day, because of the safety of his environment, that the next day will bring more of the same, because every day it increases the odds, just like the sun rising and setting, right? The sun has risen and set every day for how many thousands of years. We can say with, a certain amount of certainty that every day that goes by that happens, we're going to be able to say it's going to happen again tomorrow. And so the turkey looks at his life that way and says, my master loves me and my master is going to take care of me until Thanksgiving happens, which rewrites everything that had been done before and showed that all of the prior things that have happened about the master caring for him and giving him food, giving him water, place to sleep, shelter, protecting him from predators was really in order to fatten him up and prepare him for the one thing that really did matter, which was the turkey's Black Swan event, Thanksgiving, where he gets slaughtered. And quite honestly, whether they knew it or not, or whether they were fooled, or whether they intentionally pulled the wool over their own eyes or not, all the investors in the Bernie Madoff hedge fund were turkeys. You look at this fund and say, it's taken care of me. There's no volatility. There's no drawdowns. There's no spikes. I don't have to worry about it. It's making more money than anybody else consistently. I'm going to invest in this. Ignoring the fact that what this fund was doing was actually impossible. It's not possible to post better returns with zero volatility than market averages over long periods of time. Now, it's certainly possible to outperform the market. That's not what I'm saying at all. But you can't consistently do this with zero volatility. The only way you eliminate volatility is by eliminating return. Like, for instance, a CD is not going to have volatility, but you're also not going to make 12% a year. Said another way, volatility does not equal risk. In fact, many times something that is low volatility is really just suppressed. The volatility is suppressed, meaning it's hiding the risk that is actually present. Think of a currency peg. You've got one currency that's pegged to another currency, or even back in the day when currencies were pegged to gold at a fractional reserve ratio, let's say 40%, like in the case of the United States. Well, the dollar value of gold didn't change for decades, right? $35 an ounce for an ounce of gold. Institutions and countries could just say, hey, I'm going to give you dollars, give me the gold that it's worth. And there was a peg to gold. There was a currency peg going on. Well, if the free market had been setting the price of gold, it would not have stayed at $35 for so long, because the Federal Reserve was printing a lot more dollars than the $35 per gold peg could hold to. And so when the rest of the world realized, hey, there's too many dollars and started exchanging it for gold, it just sparked a run on gold because they realized the value of the gold is a lot higher. There's not enough gold to back up all the dollars, so I need to get my gold before it runs out. Well, clearly that didn't work. They were 2 weeks away from running out of gold, so Nixon closed the gold window. And obviously, post 1971, the price of gold has gone from $35 an ounce all the way up to today around $1,700. The same thing happens all the time with currencies that are pegged to other currencies, where there's a peg that a country is trying to hold in place, and so they have to defend the currency, deploy a ton of resources, and that peg, the free market would have moved it around, let that real risk get worked out by the price mechanisms built into the market. But the country decides, no, we got to maintain this peg, hold that peg there artificially, suppress that volatility, don't let it move, and then ultimately they fail. And then many times the currency actually fails from that or close to it. It's just like a forest fire, right? You need the small fires to happen to burn the dead wood. You need that oscillation, that volatility between creation and destruction, between the regrowth of new trees, new life, new plants, and then small fires that burn down old dead wood. You need that oscillation to happen in order to have true healthy growth over a long period of time. And then systems that try and do the opposite and try and suppress that destruction, suppress that volatility, what you end up having is a buildup of deadwood. And you have, California fires and Australia fires that threaten to burn down everything because everything is now deadwood. This is why recessions and depressions and crashes, stock market crashes and bankruptcies, these are good for economies. These are good for markets because it clears out the dangerous stuff and it eliminates the false sense of security that lulls investors into believing that everything is fine when really there's rot building up in the foundation of the system that will lead to a much bigger collapse and much more pain than would have happened if you would have just let the isolated incidences of destruction and failure happen along the way. So moral of the story is, the less volatile something is, either it is just going to have much less returns, or that low volatility might actually be suppressed volatility, meaning it is extremely risky. So volatility does not equal risk, and many times the most volatile assets are the ones that you can distinguish signal from noise most clearly and will have better returns long term, and you don't have to worry as much about suppression or manipulation because you can see all the movement that's happening because the volatility is out there in the open. You don't have to worry about things being suppressed and then breaking open for all to see. Now, one of my favorite ways to take advantage of volatility is by dollar cost averaging, also known as stacking sats, with Bitcoin. And I use Swan Bitcoin. They're extremely easy to use, extremely focused on high security. They make it really easy. I think you can invest as little as like $5 a day. And with something as volatile as Bitcoin that moves up and down, 10, 20, 30% extremely quickly, it's really nice to be able to take advantage of that volatility by buying little amounts every single day. That's going to maximize your returns, allow you to lower your cost because you're buying more of it when it's lower, less of it when it's higher. So you're lowering your average cost over time. And they even do auto transfers to a wallet of your choice. And if you sign up with my link in the description below, you'll get $10 worth of Bitcoin free just for signing up. As always, I really appreciate you guys. Thanks so much for watching. Have a good day.